Okay, brilliant. Let's get started. Hi, everyone. Thank you for joining us today and welcome to our Evolving World of Crypto and Digital Asset Tax Compliance webinar. We are delighted to be hosting this event. For those of you who don't know me, I'm Abigail Hawthorne and I work as part of the marketing team at TAINA Technology. It's so nice to be e-meeting everybody, but hopefully we'll be able to do this in person again someday. Just some basic housekeeping. I know that when you entered Zoom that this was reminded to you by Zoom, but I just wanted to reiterate in person that this webinar is being recorded. We'll be publishing the recording on our website afterwards, so please do give all your attention to the session and the panel. We'd also love to hear all your opinions and any questions, and for you to really engage with the panelists. So we'll be running 3 polls throughout the duration of the webinar, which you'll be able to access through the link that you can see in the chat section in both your Zoom and WebEx chat, or by scanning the QR code, which you see on the screen currently. So this would be a good time to get your phones ready. I'd also like you to be able to ask any questions you have around each topic in the Q&A section, which you can find again at the bottom of your Zoom or WebEx screen next to the chat section. We'll try our very best to answer all of your questions in the Q&A session, which will take place in the last 10 minutes of the webinar. If you are having any technical issues, please do let us know in the chat section, which you can again find at the bottom of your Zoom or WebEx screen. Okay, without further ado, I would like to introduce our wonderful expert panel who have heaps of tax and compliance experience, both in the crypto and digital asset market and across the industry. They'll be sharing with you their insights and learnings with a specific focus on the evolving regulatory landscape and changes that are impacting the crypto and digital asset businesses. On the panel, we have Nelson Sweet, Managing Director of Information Reporting and Withholding Tax at KPMG. We also have Erin Fennimore, Head of Tax Solutions at TaxBit. We also have Raj Mukherjee, Global Head of Tax at Binance US. And lastly, we have Rasheed Khan, Managing Director of TAINA US. Before handing the mic over to our panel, we're going to kick things off with our first poll. You can participate in this poll by scanning the QR code that you see on the screen now, or by clicking on the link that you can see in the chat section. If you're having any technical difficulties with this poll, do let us know in the chat section and we'll do our very best to help you. Okay, I think it's time to look at our results. There we are. Now you should be able to see the results. And with that, I will hand over to our panelists to discuss.
Thank you, Abby. So my name is Rasheed Khan. I'm the Managing Director here at TAINA. I look after a lot of our product offerings here for North America. I'm joined today with a group of experts in the tax field who, are supporting either their own tax departments and tax operations. And we also have Nelson from KPMG that obviously assists with various different organizations with their tax solutions. We want to have a discussion around the crypto and crypto reporting, primarily because we know that with the finalization of the infrastructure bill now becoming an act, that we all have to start planning and thinking about what are we doing in order to comply with those reporting rules, and how do we deal with aspects of the rules that the rules do not address. And I love the fact that we have a panel of diverse people who have already been looking at and thinking about some of these things. So the first question that I have for the panel is, what are some of the comparative differences and difficulties between executing cost-basis reporting for digital assets versus traditional securities and stocks in the market today?
Erin, do you want to go or should I start?
Are you going to get us? You can get us started, Raj.
All right. For those of you who don't know me, my name is Raj Mukherjee. I'm the Global Head of Tax for Binance US. So Rasheed, that's actually a really relevant question. For regulated exchanges like Binance US, I think the challenge is that traditionally in the crypto world, there was no regulatory requirement to record or track cost basis, right? So what we have is a situation unlike in sort of the traditional financial markets where if you have a buy and a sell on the same exchange, such as Binance US, then the cost basis information is tracked, right? But if you have a user, and this is the case in majority, I would say, of users that have multiple wallets, and they move assets between wallets from one exchange to the other. Traditionally, unless the user is conscious enough to send the information along with their assets to a different exchange wallet, there is no tracking of cost basis. So with the infrastructure bill, rebranding the asset class from property to security, I think what we need to be very aware of and start tracking and have a cohesive agreement amongst exchanges is that the transfer statements from wallet to wallet should have the cost basis tracking, because this will help us not only to track cost basis across, make it a better user experience, but also help us comply with the regulations. Erin?
Yeah, so piggybacking off what Raj said, I think looking at it first from the individual, so the taxpayer's perspective, the difference in digital assets versus traditional equity market is the established nature. Along the lines of what Raj is saying is that if I'm investing in stock and securities, well, I don't really have a lot of onus on myself, right? The financial institution is going to hand me over that information, with cost basis, transfer statements for purposes of preparing my own tax returns. But, in this new world of digital assets come February, I'm kind of sitting here without the information I need to prepare my own tax returns, because there's this disconnect between information reporting, transfer statements, and income tax rules. And I think that impacts what I'm seeing in my view, and please let me know, Raj, if you disagree, but because of that impact to the individual taxpayer and the account holder, I'm then turning to the exchange and saying, hey, if I was buying Apple stock, I wouldn't have these problems. So how are you going to close that gap for me if I'm going to continue to stay as an account holder on your exchange? So they're really looking for more customer service before those regulations and those requirements are in place. And so we're all kind of in this gray area figuring it out together.
No, that's definitely so, Erin. And I'm just thinking from the broker and customer experience, right? Maybe the Infrastructure Act that passed in November may change some of that in the coming, maybe beginning in 23, 24, as brokers become and exchanges are required to provide that sort of tax information to customers. I've also been sort of thinking about the question from the exchange and sort of a broker side of the equation, where I think in terms of looking at the differences between crypto reporting versus traditional securities and stock reporting, there is this difficulty in terms of thinking about where all the sources where customers are acquiring digital assets. In traditional stocks and securities environment, often where you obtain the stock and securities is when you buy it, right? You buy it off the exchange, or maybe there is a transfer in as a gift or otherwise. But for crypto, you might be able to obtain the crypto via incentives, right? You might obtain it via staking rewards, crypto lending, maybe as a reward from crypto lending. It could come as a transfer, or it could come as an acquisition off an exchange. So you might have to monitor all these multiple sources of potential acquisition events.
Yeah, I think there's something, one of the things that I heard both yourself, Erin, and Raj talk about in other forums is, the fact that in the securities exchange, there's a concept of a primary market. In that primary market establishes a standard price. Even if it's dual listed, it's still tracked off of the same primary market pricing. In the case of a crypto, there are multiple exchanges that handle the same crypto, and there may be slight variation between the pricing. So even from a cost basis perspective, two people buying at the same time across different exchanges can easily get different pricing. fairly different pricing for that particular item. I think that this is actually going to create some discrepancies within the industry, primarily when you buy within one exchange and then you move it to from one from one wallet holder to another, because when they if they try to reconcile it versus what they have as price for that particular acquisition date, it may not match up.
I think, Rasheed, for that purpose specifically, it's really important to have sort of a standardized rules, not in terms of the pricing, because look, crypto is a volatile asset. We all agree with that. And it's never going to, well, it's most likely not going to be the same sort of standardization that you spoke about in the traditional securities market. But I think that highlights the fact that, you know, at least amongst the regulated exchanges, you know, there needs to be an agreement, and hopefully that'll be defined by the regulations when they're released, on exactly what information needs to be sent when assets are transferred, right? And that forms the history, if you will, from the buy to the hold to the sell. And I think that is, like, I know I keep harping on it, but I think that's the only way we'll be able to track this.
Oh yeah, I was just going to say, Raj, that's a great point, because like you said, in a market that has volatility with pricing, like it has variables, which Nelson is saying, in terms of where you're acquiring and how you're acquiring the assets, you have to have something that's static, right? That is a known factor across all exchanges when you know there are already 17 unknowns to begin with. I just think, you know, we're all on bated breath, waiting for what is that requirement? Is it going to look just like a transfer statement in the traditional equity world? Surely there has to be differences. So I think we're just all in a holding pattern.
I think the other thing that from a transfer or from a cost basis perspective that is still open to me and is around the mining, traditional mining type of activities, right? Is that something that gets zero basis, or is it something where it has a stated value because you're essentially being paid for services rendered? And how do you calculate what that value, what that value is at the time of the payment? The another question that we have is around how difficult do we think it will be around maintaining cost basis information, a lot of the details, as assets are moving around? Do we think that, you know, like with standard equities, there was a standard information that was provided as part of a transfer statement? Do we think that the existing attributes of a standard transfer statement are good enough for the crypto market, or do we think we need to enhance that in any way for the crypto market process?
You already alluded to the fact that maybe we need something more than the standard transfer statement for security. I mean, in the traditional sense, right? When I have stocks and securities in one brokerage account with broker A, and I want to transfer to broker B, they issue a transfer statement with the cost basis information to broker B, so that broker B can continue to maintain that information. I think the big difference is, as people will know, is there's a lot of self-custody in the crypto world. Mm-hmm. And things get transferred off exchanges, off the traditional intermediaries that monitor this cost basis information.
Along the same lines, I think the nature of how you transact in the digital asset space is so different than how you're transacting in the traditional equity market. There has to be basically, you know, the ability to have it instantaneously produced, since the nature of these transactions are so instantaneous. You know, it has to be, to me, it's almost that it has to reside within that ecosystem in a digital format and follow all these trades, almost like attaching a smart contract somewhat to the trade that follows that transaction, wherever it may be, because it's going in and out of, you know, traditional custodial wallets, cold wallets. There's just so many different mediums which that digital asset can live in.
I think one of the other questions that that come up as it relates to, you know, the actual cost basis adjustments is, you know, the treatment of fees or other type of middle monies activities that may occur within the crypto asset world. How do we think that that's going to impact our ability to make cost basis adjustments, or where they may actually change and affect the basis of a wallet or a holding within a wallet?
Well, I think for if we think about transaction fees that arise with respect to network transaction fees when you make transfers of crypto assets. Well, the one odd thing is when you look at the IRS FAQs on crypto taxation, they say that, well, when you transfer crypto assets between one owner account and the owner's other accounts, there's no taxable event. But in fact, when you do those transfers, there is a network transaction fee that's applied. And if I transfer, let's say, 0.25 ETH to my other account, I'll probably have to pay a portion of that in transfer transaction fees. And presumably, I don't know, I would have thought of that as a deemed sale, right, of those particular units to pay the transfer fee, the transaction fee. And then and the question is, is that being reported by an exchange that's facilitating the sale, transfer, or is that, is something happens on the network and therefore is someone else's responsibility?
Yeah, and my understanding is that a lot of, Nelson, in those scenarios, I may be transferring X number of coin, but because the fee is deducted from that coin, that means that transfer statement should also be adjusted for that deduction. But there aren't any specific rules on how you would apply that deduction, and whether or not that would have to, as you mentioned before, would that constitute a separate sale? Would you have to, would you have a recognized gain in that because essentially you've delivered off the asset?
Yeah, I think what I know is when I transferred, I had 0.25 ETH, and after the transfer, I have less than that, right? And so what happened to the?
Yeah, and my basis is my basis now against what is left, or is it? Do I have to adjust the basis and treat the disposition of the 0.25 separately? Right. These are some of the things that are not clear in the current set of rules. And right now, 6045, cap A don't address them at all. Obviously, we're expecting that 6045 cap A will be updated so that we can actually understand what are some of the adjustments to basis that are acceptable and allowable.
Yeah, just kind of going into a little bit more detail, I think the reality is that you are paying for a fee in a digital asset. So you're not paying in fiat. So, the way I view it is that fee payment, similar to I go to Starbucks and I buy a coffee with my Bitcoin, it's a taxable event. And so, and looking at it from the perspective that Nelson was saying, the reality is I transferred 0.25 ETH, but in reality, 0.3 ETH left my wallet because of that transaction. And so I think there has to be a system in place to track the fact that we are paying for transaction fees in property right now. And there has to be the corresponding, when transfer statements come about, there has to be that line item breakdown, because I'm a business. Well, am I deducting that as a business expense? I can't deduct it as a personal expense if I'm an individual against my income tax. So I definitely think there has to be that breakout between the digital assets that's transferred and the digital assets that were utilized as the transaction fee portion for that transfer.
Look, this is also another reason why, and I've said this in other panels as well, is not only do we need the regulations, which I know are forthcoming and have been for some time, but we also need adequate amount of time to decipher what's in those regulations, have those organic conversations with the regulators, and much like some of the other life-changing regs in the traditional finance world, have adequate time to update systems and design systems, or work with vendors or what have you to integrate such changes into and test out such changes, right? So that we can be fully compliant and as regulated exchanges. I think it's vitally important as we go into this next phase of getting the regs and having those conversations that we kind of remind and insist on a reasonable length of time to get ready to comply.
And thinking about the crypto and digital assets, we have traditional securities. You have things such as corporate actions, but in the case of cryptos, you have things related to forks and other type of activities that could occur against the digital asset. How difficult do we think that tracking basis or making basis adjustments around those type of events will be? And are there additional events that we haven't thought about within this space that we should be thinking about from a cost basis perspective?
I think with the digital asset market, we don't know what we don't know yet, right? Like NFTs to me is a perfect example. When I first joined TaxBit in July, of course we all talked about NFTs. Were they the hottest thing on the market? I wouldn't say they were. And then a month later, that's 90% of my day is talking to these new NFT platforms and the various ways they're, creating them, minting, selling, marketplace. And so I think that's the most difficult part for, for people like Raj that are sitting at an exchange. It's the fast-paced nature of innovation. And like Raj was saying, I think there's an underappreciation for how much time and how difficult it is to operationalize and update procedures and systems. And that's really what this digital asset economy is forcing people to do at rapid pace.
So that's an interesting one because, a lot of the information reporting rules are geared around publicly traded instruments and not really targeting private type of activities. NFTs are an interesting one because of the fact that because of the way that they're derived, are they considered to be private transactions, therefore fall out of scope of the reporting rules, or because of the fact that they're although they're non-fungible, they're so readily traded, they become in scope for the reporting rules. And then how do you deal with that? How do you deal with that on a going forward basis?
I also think that NFTs present an interesting thought process on sort of what type of income and tax do you give them. So for example, like you just said, if it's directly from an artist to a purchaser, that's one type. If the NFT is traded through a gallery, for example, a digital gallery, now that changes things because there's some royalty income involved there. Then there are open marketplaces where both individuals and galleries and other actors come in and trade NFTs. So I think it does create challenges and both excitement and challenges in that market. But the other thing I wanted to also say, talking about other, one of the things I've been thinking about is, surely but slowly we're going towards derivatives, right? Crypto-backed derivatives. Like that's going to also be very challenging. Then you have the issue of wrapped versus unwrapped Ethereum, for example, and where does the airdrop and the hard fork happen? So I think the exciting part about this world, and I think which drew a lot of us into it, is the fact that it's so highly creative and innovative. But that also means that I think, and I empathize with the regulators here, because I think we're trying to, or they are trying to sort of work in this new paradigm where they're looking at rules that have been around for predictable assets, right? And trying to think, how does this fit this new paradigm? So I think, as Erin said, we're all learning together.
Yeah. I think your derivative, I think the point you make of taking very traditional, clear rules and applying it to a completely new market, new product, new scenarios, derivatives is a perfect example. We are we have that support, and I can tell you, taking traditional derivative rules and applying it to the digital asset market, it's extremely, you know, difficult, and it really forces you to think outside the box and apply these rules in real life scenarios to the digital asset world and the details of those transactions. And it changes the outcome of what you would have applied, you know, in that traditional information reporting or traditional tax analysis with Apple stock, for example.
Yeah. No, I definitely agree too. I mean, I think offhand, when you think about it, oh, some people are sort of relieved that in the crypto world, we might not have to deal with corporate action events, mergers and so forth, and also all the complicated adjustment for debt instruments, from OID to bond premium to market discount to contingent payments. But then what Erin and Raj, what you're saying is entirely correct, right? There's a lot of stuff we don't know when applying the traditional rules to crypto events, and sort of this whole environment where you could have these derivative instruments on crypto. I mean, even if you take something relatively straightforward as crypto gets, as a hard fork, right? The IRS tax rules says the event happens generally for a taxpayer when they have dominion and control, and this might be different on any particular, depending on the platform the particular taxpayer is on when the events happen, and that's something you don't really have in traditional securities, where, you know, merger happens for stock A on day one, and everyone sort of has that acquisition, has that merger event happen on that particular day. It's not the same for crypto.
Yeah.
I think this is a good point for us to break for our next poll question.
Again, you can access the poll by scanning the QR code, which you can see on your screen now, or we have just reposted the link in the chat section. Again, I'll give an opportunity to our Zoom and WebEx audience to get their answers in before we switch to seeing the results.
I think this is a good one for us to lead in as our next item and topic, because I think with in my former world, when we were originally contemplating having to do reporting for digital assets, we were doing some analysis against our existing portfolio accounting systems, right? And whether or not we could just trigger it off of portfolio accounting systems. So it's a good question for our next topic.
Okay, I think with that we can share and see what the results look like. Okay, back over to you, panelists, to discuss the result on the screen.
Yeah. That's interesting. I think it is interesting that only 4% looked at expanding their existing portfolio management tools. I think what is positive about that is the fact that one of the things that we looked at when I in my former life as looking at the analysis is our portfolio accounting tools were geared around securities instruments. They weren't really geared around being able to handle some of the other adjustments that could impact a digital asset or digital currency. Although we did see that we could still handle a lot of the derivative products like futures on a crypto or on a digital asset, we knew that some of the other products, swaps and things like that, would not be able to be handled within the existing process. Raj, Erin, what have you guys thought about doing from a cost-basis solution standpoint? Are you looking to expand what your current portfolio tools provide, or trying to build something fresh and new, or come up with a new solution altogether?
Yeah. So look, I mean, Binance US has a set of extraordinarily smart engineers and biz dev people. However, the question that I ask is there time most wisely spent in building tax solutions? I think the answer to that question in my mind is no. I think their time is better suited in doing other things. So my approach to this has been to look to the market, to the experts that have built or are building solutions, and that's their area of expertise, and that's sort of their that's their work, and see which one can be customized to fit the Binance infrastructure, Binance US infrastructure, and internal architecture that we have in terms of providing a compliance solution as well as ease of customer use at the end of the day, right? So my focus as the head of tax is to make sure, one, that as a regulated exchange, we're compliant on time, we have proper audit records, and that our customers at the end of the day get what they need to do their own tax reporting, right? So in my mind, I look to outside solutions, and the ability of those outside solutions to sort of come in and show me how they can sort of integrate their product into in a compliant way within the Binance US architecture, so that at the end of the day, the exchange is compliant and the customers are happy.
My first thought was what I heard Raj say is that I'm an expert, because all we do at TaxBit is build software. That's what we specialize in. So, I can tell you what we're doing from this perspective is exactly what Raj is saying. Like, we're uniquely positioned to focus on building software for this compliance that's dynamic enough to change as quickly as these regulations, become finalized. And surely there's going to be gray areas. And so as those, subsequent new innovative products in the digital asset space come about, or there's clarity in future loopholes, which there's going to be, our solutions are built on a foundation that can easily be customized and be adjustable to react to those new requirements. In terms of the cost basis, I think everyone is kind of saying the same thing, right? The biggest challenge is cost basis across platforms, and looking at the digital asset community. Not everyone is like me. I go to Binance and I do all my trading on Binance because, I'm a little bit vanilla. Most of the crypto market is not me. They're trading cross platforms much more routinely. And so that challenge is capturing the cost basis. And so what we've done here at TaxBit is develop software to catch that cost basis. Because all of I'm not sure if everyone saw, the news blast yesterday about the TaxBit network, because our client base consists of all of the, premier crypto exchanges and platforms. By the nature of our consumer tool, which houses all of that transactional information, our tools can recognize when transfers occur across platforms, and it can carry forward that cost basis. So it's basically automating transfer statements before they are required in any sort of format, whether that be physical or digital. And so that's really, how and why we built our tools the way we did, knowing that ultimately was what was causing so much pain to begin with in preparing tax returns from the individual level, when crypto first really exploded 5-10 years ago.
So Nelson, I think you have a slightly different perspective, because you're dealing not just with some of the crypto or exchanges, you're also dealing with financial institutions that are entering in, or at least managing investments into digital assets for clients. What are you hearing from some of those traditional financial institutions that are also doing this, right? What are their plans?
Yeah. No, that's a good question, Rasheed, because I think we're seeing a bit of some differences in perspective, right? From traditional financial institutions that already have an infrastructure in place for stocks and securities, and then trying to think, well, if we head into the crypto world, can we sort of leverage off what we currently have? And some of them use outside vendors as well. And so they talk with outside vendors as by you accommodating crypto trading within your solution. So I think there's that versus some of the more crypto native firms. I don't think they have an infrastructure yet. And I think they are open to all sorts of solutions. I think from what we hear, I think is probably in accord with this poll, Rasheed, right? 59% are still are still considering how to proceed, and a number of them are waiting for the regulations that are expected to come out from Treasury. But a good number are thinking seriously. Maybe the outside vendor solution, as Raj said, is easiest. It allows them to do what they do as a business optimally, while outsourcing a solution to an outside vendor that focuses on just tax software. So we've been hearing different things. There's more. I think there's more inclination in the traditional financial spaces, as you mentioned, Rasheed, in terms of wanting to leverage what existing systems they have, because that they have already an established workflow.
That makes sense, Nelson. Like, in my past life, I used to work for a rather large investment bank, and we had massive ops teams and dev teams and as you say, basic infrastructure that's already built in, and it was a matter of customizing that to whatever digital asset world that the traditional financial institution wants to get into. For the rest of us that are crypto specific, this is like the starting from scratch, literally, right?
Okay.
And again, it's the one struggle that was there in the past when I worked in a traditional bank versus now is internal resources, right? There's always a pull on internal resources, and so when I have to explain my business case to the C-suite, my position is, okay, how can I most effectively use those internal resources like engineering and dev to already take something that works and just figure out a way to sort of marry the two, which, as you all know, having worked in the various capacities that you have, is not an easy task either, and can itself take months and months. So, but your point is well taken. Sorry, Rasheed.
No, I was going to say, right in line with what you're saying. One of the things as an observation is, the wait and see type of approach to the regs always seems to get us, right? Because of the fact that by the time the regs come out, you have a short time frame to try to implement. And the other thing that's around what you were just saying, Raj, around resources, right? There are large resources, but there's been a big push to business transformation. And from a business transformation perspective, many financial institutions have been rethinking, is this part of our core product? Is operations really what we want to have big, large teams in? And that takes away from resources that we could put into developing new products, solving or providing for customer service on the trade and execution side. And that actually does take its toll on a tax operations team and being able to meet some of these rules. With that in mind, Nelson, have you guys come up with an approach on how to advise clients on how they do their analysis around a build versus buy solution?
I think at this point, Rasheed, I think we're still at the stage of helping clients understand what the framework for the new reporting rules would be, and also doing an initial assessment of their readiness based on the existing systems. And then I think they would be in the point where they can then decide, well, this is where we are, this is where we want to be, and so what's the best route to get from here to there? So I don't think we are there yet in terms of recommending build or buy, more just assessing readiness at this point.
Yeah.
Last question before we jump into our final poll and Q&A, and obviously if we don't have a lot of questions, we'll jump into some additional topics. But thinking about the changes to 60/50I, right? And we start to think about transfer of digital assets. And if you look at the way the regs, it's similar to the way you're transferring any other type, doing any other type of currency exchange, even though they don't consider the crypto and digital assets to be currencies. You do have to report whenever you have a movement of currency of 10,000 or more. Does that create any concerns? What are your thoughts around those modifications in the rules?
From my perspective, I think the biggest thing we're hearing in terms of the concern with this requirement and that form is the information that is ultimately reportable, right? In the traditional reporting rules, it's really recipient specific. So systems are set up to capture that, information to report forward. This form is different in the fact that it's collecting both sides of the transaction and reporting that forward. So it goes back to that question that, we just discussed of, how do we update systems internally to start capturing this information that historically we didn't capture? That's going to impact onboarding, that's going to impact tax, that's going to impact customer service, monitoring that information, making sure it's correct. And so I think operationally, it's giving a lot of concern about potentially having, being swept under these regulations and having to report forward that information.
Yeah, I think in my position, I would echo everything that Erin just said. With the addition of the fact that if the government wants the information as regulated exchanges, we will comply, but that doesn't take away the challenges of everything that Erin just pointed out that still need to be worked out and built into the systems.
And then this particular provision has impacts across all business industries, all businesses across different industries, right? And I think the problematic part of the framework is that the 6050I provision was initially designed for not just currency, it's cash, right? Cash, you expect someone, a physical person, to show up with more than $10,000 of cash, maybe at a used car dealer to buy a car, and you can see the person and ask for their ID, which is what you put down in the reporting form. This isn't really the case when you transfer, more than $10,000 in cryptocurrency, where you might not even know who's sending it, and they could just send it to you without you even acknowledging it, assuming they're generous, right? They just need to know your public address for your wallet. So it's a very different environment, I think.
I think Nelson, you would agree that I think part of the reason, at least I think, and again, harping back to some of the other regulations that we've all sort of swam and sunk and swam back up again with, is that it all leads to, it seems, the government wanting more due diligence information, right? More at onboarding, more verification of KYC, and dare I say, for the first time in the crypto world, tax KYC. Right, and which is a whole nother animal altogether, right? And I think it's all leading towards that. I think these are supposed to sort of go hand in hand, and for the government to come in and say, look, I need to know where it's coming from, who it's going to. Here are some thresholds, and I think I fully expect that moving forward there will be continual conversations on, here's the regs, and like, what does the implementation practically look like, right? Because a lot of things, as we all know, looks amazing on paper, but then modifications are required for the real life to work. So I think that's going to be the next phase.
Yeah, I clearly think there are going to be some FinCEN regulations that are going to spin off of this as well.
No, I think this is supposed to go hand in hand with the FinCEN regulations that apply to financial institutions. This will apply to the non-financial, but crypto is somewhere in between. Some firms are under those categories of financial institutions, some are not.
I feel like also, first of all, Nelson, every time I think of that form, I always compare it to a used car dealership. So I love that you use that, because that's exactly how I conceptualize it. But I think everything that everyone's saying right now too, it reminds me when CRS came about, and for any, traditional financial institutions that are, listening in, this is the reaction that we all had when that came out. You want us to collect how much information and in what format, and you want us to report it forward worldwide? I feel like we're there again. So these are questions and situations we've previously been in. It's just a totally different marketplace and scenario with digital assets. And so, but I think that, you know, these are not necessarily completely new questions and scenarios we've been faced with.
I think there's a good spot for us to transition into our final poll.
There we are. Just a reminder to everyone that you can scan the QR code on the screen now, or you can click the link that is in the chat section. And then after this final poll, we'll be moving on to our Q&A section. So just a reminder, this would be a good time to pop any questions you have for the panelists in the Q&A section on either the Zoom or WebEx chat, and we'll do our very best to address all of your questions in the final 10 minutes of this webinar.
Erin, I think what's funny about the CRS, you were talking about when they first announced, I cringe every year because, you know, every year you see another country come out with some additional data requirements. You know, last was Cayman and Bermuda, and you know, it's the gift that keeps on giving, right? In that you can't seem to ever collect enough information for any government to be happy and say that, oh, we have enough in order to make sure that we're collecting the right amount of tax, right amount of tax or income.
It's also funny that we're talking now like, oh, do we only have 12 months to get this right? And remember that one year when the Cayman Islands dropped new regulations a week before the due date? Oh, and then updated their portal. You know, we had 7 days.
And all of our filings failed. I remember that all of our filings failed. So this is great. I think this is in line with what we were just talking about. And the fact that most people are concerned around the independent exchanges and market pricing, you know, something we talked about, the fact that there are slight differences. It's not, you don't have a primary market to rely on in order to go back and identify what cost or what price you should be applying. There's a good time for us to start looking at questions, and our first question is one that I think is an interesting one because it's not just limited to one country. I think there are a couple of countries, and the question is, do you believe that as countries are starting to adopt Bitcoin or other digital assets as part of their primary currency or as part of their national currency, do we think that the IRS will start to treat them as Forex? I mean, from my standpoint, it's going to be hard for them to transition from treating them as property to then treating them as currency. But what you will see is that there will be an exchange equivalent that you'll have to track when you have an FX gain because you've exchanged Bitcoin for some type of some physical currency, and you're going to expect that there's going to be an FX gain piece as well as any other non-FX gain. You know, Raj, Erin, you know, Nelson, do you guys see it any differently?
No, I mean, I think I would kind of parallel what you're saying, Rasheed. You know, in terms of the US, we've really started down the path of property, right? And treating this as property. Are we gonna then make an entire 180 and start treating it as currency? You know, I don't necessarily know if that's the case, but I can't opine for other countries. You know, we're already seeing it happen. And so I think that's just another challenge where digital assets are going to be treated differently across different jurisdictions. That's going to add such a complexity, especially for, you know, the exchanges that are opening exchanges in different countries. You have one exchange in a country that treats it as currency, one exchange that treats it as property. I mean, how do you operationalize that?
Yeah, that at that point you end up with disparate systems dealing with it from a local level, and that's never good.
No, it's not good. Raj, stay out of El Salvador.
Binance US member.
Oh, yeah.
I think the next question that I see that is something that we can address is around, whether or not for crypto and digital assets, will the reporting actually be January 2023 or January 2024? I think what you will see is that depending on when the regs come out, obviously the legislation dictates that it would be January 2023. But if the regs continue to slip further and further into 2022, you will see an industry push for that to move out. And, at minimum, what we can hope for is in 2023 that there'll be some penalty relief if they don't shift the date. But that all depends on when they actually release the final regs. Now, what we're expecting is that they will issue draft regs, and there'll be an open period for comment. And depending on how close to the deadline they start receiving some of that commentary back, may push final regs out to later in 2022. If it comes out after July, if the final regs come out after July of 2022, you can almost guarantee you there's going to be backlash from the industry for a movement of the date as well, primarily because one of the standards that we've always built our premises on is that we need 18 months of build time, and that's enough for us to be able to isolate budget, put a build in place, test and validate it. That's the way I look at it. That's what I've seen from my former time on SIPMA tax committee. I don't know if you guys have any other thoughts or think it would go any differently.
So I think I agree with you, and I think that the further we get back in, further we get into 2022, I expect that they would probably have transition periods where they may say, okay, collect XYZ for this year, but you don't have to do ABC. That'll come the year after, because let's not also forget, in my wearing the hat that I am, and I'm thinking of onboarding and again the tax KYC portion. I have to also figure out, okay, even if I institute the new rule to say, okay, I got to collect forms XYZ for new customers, I have the whole pre-existing customer problem, which need to be documented. And I think in fact, that we had like, what, a year and a half, 2 years to kind of get all of that done. So I think what happens in the meantime, right? So I do think that I expect the regulators to sort of follow, or let me put it this way. I'll be very surprised if the regulators depart from their usual tendency to say, let's have transition years, let's have a phased implementation, because at the end of the day, if the intent, and I believe it to be, is to have maximum amount of compliance from this industry, then I think it makes sense that the timeline is pragmatic.
Yeah. I agree with Raj. It seems that some sort of phased approach would be a reasonable compromise between the effective dates in the statute and what can practically be done. I mean, when you look at the way cost basis for stocks and securities were implemented, that came in a sort of phased approach based on products, right? The simpler common stock got in first, and then the more complex debt was sort of last on the chain. And maybe you could sort of conceive a similar approach to crypto with some of the more complex transactions, or even cost, maybe proceeds first and then cost basis a little bit later, and some of the more complex issues dealing with transfers, right? In a more phased approach, as you mentioned.
Yeah, I think from a tax regulations perspective, phased implementation seems to be, there's a standard there for doing that across various rules and regulations. But I think that what's going to be important is that don't wait till the draft rules come out. What we should be doing is sitting with industry and industry members and thinking about how do we map out what that phased implementation would be and what would make sense from our standpoint, so that this way we have a baseline to push Treasury, push the actual people who are drafting the rules towards implementing rules, or at least putting together rules now that would apply that, so that this way it eases the burden on the industry. So I believe we have a couple minutes left. I think we touched on a couple of different questions in answering the deliverables, but I think there is still one item that I think we need to look at. Do you guys think that there would be any of the digital assets that would fall out of scope from a reporting standpoint? Do we think that there's enough information from the Act that helps us determine that certain digital assets would just not be covered?
From my perspective, I don't see that being exclusions for certain digital assets. I think what we're all anticipating is certain exclusion for different entities operating within digital assets. But I hadn't considered or think that a specific type of digital asset will be excluded. But again, there's a lot we probably don't know that will come about in terms of what's a digital asset, you know, gonna look like in 2023 or 2024.
Yeah, I would have to echo that. I think there would be actors that would be carved out mainly because if you look at sort of the fundamentals of 60/45 and the agency relationship that it proposes, you know, there are certain actors within the digital world that just don't fit that definition. And if we look back to some of the conversations and the colloquy that happened on the floor, even though that's not written law, we know that there were indications from both sides of the aisle that there were certain actors that just did not fit the definition of what they were trying to do. But I think it would be a harder time to go to regulators and say, well, this asset should be excluded versus that asset, right? Because if, you know, look, at some point we need to grow up as an industry and if we want to be treated with the same amount of seriousness, then we need to play in the same sandbox. So, but that doesn't mean the compromise is not reasonable or feasible.
Okay, well, unfortunately, we have reached the end of our webinar. Sorry to interrupt you there, Rasheed, but I do want to say a big thank you to our panel, Rasheed, Nelson, Erin, and Raj for sharing their insights and a lot of really good information in there. Again, I also want to remind our audience that we will be sharing this recording with you, so please look out for that. And we will also be sharing some extra collateral from our panelists in an email as well. Lastly, I want to thank our attendees for taking the time to join the webinar. We have very much enjoyed hosting you and hearing all your questions and your opinions. We would really appreciate it if you take a final few minutes just to answer a quick feedback survey that you'll see as you exit the Zoom call. And with that, I want to say thank you to everyone and wish you all a very great rest of your day. Thank you so much, panelists.
Thank you.
Bye-bye.
Bye.